In this lesson, we're going to expand on the concept of effort versus result and show examples from the charts of how you can spot this and how you can use it to build a better picture of price action. The key to the application of this concept is the word "and." So if you look on the left at a basic retail trader pattern, a bull flag, if you find this from a textbook or like most unprofitable novice traders, they see them in textbooks, YouTube videos, etc., and it tells them that when price does a bull flag, you buy. The problem with that is you're only looking at the result. They're ignoring the effort. They're just looking at this pattern and saying it should play out. But they don't have an insight into, are there big players present? Is there support behind this move? Contrast that with the right-hand side. The correct way to view any pattern is effort, which is volume, and the result, which is price. Are they in harmony or in divergence? In this case, a successful bull flag will see they are in harmony, meaning you have above average high volume in the impulse higher, low volume correction, and then above average high volume impulse higher, effort and result in harmony. Once you view markets through the lens of effort and result, you're closer to cracking the code of price movement. So let's look at several examples now and show you what the charts are saying in each phase of price action. These examples will build upon each other from a single candlestick all the way up to an entire wave, so that you can watch in real time as price develops and be able to estimate just from effort and result where it's going to go next. Single candle. For harmony, that equals a high volume with a wide range, meaning a wide-ranging candle, or low volume and a narrow range, a narrow candle. Both of those indicate harmony, because high volume, wide range is what you expect to see. Remember, harmony means agreement. It's what you would expect. It's what would be correct if price was going to continue doing what you think it's going to do. And low volume, if you have low volume, you wouldn't expect price to move much, so you have a narrow range, like this photo. Because harmony is continuation, it means the impulse up, you then see harmony in a red candle, but very low volume and narrow range, likely continuation, and sure enough, it continues. Divergence is the inverse. It's high volume with a narrow range, meaning a very small candle but high volume. That's telling you something. That's telling you the price isn't moving in the direction of trend as easily. Or low volume with a wide range, which is an inefficient move and is telling you, why would there be such a wide-ranging candle but low volume? Maybe this move is not sustainable and the trend will reverse. So the example in the picture, above average volume on the blue line, but after some nice full-bodied high volume candles indicating trend, we then see a very narrow, a small candle, but with high volume. That's absorption. That's the price is going to reverse. And sure enough, it does reverse. Let's take it further. Now let's look at follow-on. As the name would suggest, this is a follow-on to your candles. This is not looking at one candle. This is looking at a series of candles. And so for harmony, in terms of this, you want to see high volume, bullish candle and price driving up. Or a high volume bearish candle and price driving down. Just exactly what you would expect to see in a strong trend. The volume and the big candles and bullish candles continue to drive price up. So you take your one candle on the left, it's this large green candle with big volume. The harmony for follow-on is the next part, the phase where it continues up and the big candle continues to push price up. Your bullish candle continues to drive price up. Harmony. Divergence is again the inverse. High volume, bullish candle, but price fails to drive up. So we have this high volume, bullish candle. We then have a couple of candles after, all with above average volume, but price fails to go up. So you have bullish candlestick patterns, and if you just trade candlesticks, you would have made a mistake here. But when you factor in volume, you say, these high volume candles are not driving price up. That's a sign of a divergence. That means where do we come from? We came from an uptrend, likely reversal. Taking it a step further, now let's look at effort versus result within an entire move. So we've taken candlesticks, we've taken multiple candlesticks. Now we're looking at a full move in terms of impulses and corrections. If you remember from previous lesson, impulse is where price moves strongly in one direction, and then the correction is when it retraces in the opposite direction in more of a sideways up or down manner. Harmony for an impulse move would be increasing volume with that impulse. So as price impulses higher, volume rises with it, as in this example. Obviously the same on the downside. If price impulses lower and volume continues to rise, it's a continuation sign. Remember, harmony is continuation, divergence is reversal. Also, you can have decreasing volume and a corrective move. For divergence, we see decreasing volume in the impulse move or increasing volume in a corrective move. Okay? Remember the word "and." That is what separates you from a basic unprofitable retail trader. In the example, we have an impulse where strong moves up in terms of just the candlestick, strong move up, breaking resistance. But if we look at volume, we see volumes declining. So that's your first early sign of a reversal. of a divergence. And if you remember what divergence means, it means disagreement. So look at the up arrow. Instead of being in agreement with the other up arrow, the up arrow is in disagreement with the volume arrow. So the price is in disagreement with the volume. Taking it again a step further, now you can look at entire structures of waves, full waves, and see how an actual entire trend develops. And again, this is on all time frames. For harmony in waves, you're looking for an uptrend wave and an impulsive move, or a downtrend wave and a corrective move. For divergence, you're looking for a downtrend wave and an impulse move, or an uptrend wave and a corrective move. Looking at the example, this is harmony in waves because we are seeing impulse moves, impulse moves, impulse moves, impulse moves. All the while, the average volume is rising from lowest and similar here, but still rising as we go here, rising as we go here. So the impulses are on ever increasing volume, and the dispersion of the actual candles is getting greater too. The moves are getting bigger. If the moves get bigger as the trend develops, that's a sign of a strong trend. That's a sign of harmony, a sign of continuation. For divergence in waves, we're looking at the impulse, the next impulse, the next impulse, and the next impulse. 4 impulses, 4 waves, price action. But look at the volume, decreasing each time. Declining volume as you rise is not a sign of harmony. That's not a sign that this trend is going to continue indefinitely. And sure enough, if you expand that chart further out, that move ended and reversed. It's a sign of early reversal, divergence between price and volume. So using those 4 examples, you can build entire structures all the way from a single candlestick to an entire wave, or multiple waves. And finally, this is separate and can be used at any time. How does price react at key levels? So breakout trading and breakdown trading are 2 of the common types that people get wrong. Retail traders lose the most money on breakout trading as anything. The correct way to do it is not to look at a breakout, but to look at harmony and divergence. When you have a key resistance or support, but in this example resistance, and we break out through it with high volume, and the level breaks and holds, you then have a low volume retracement, and that level respects it with low volume. That is harmony. High volume breakthrough, failure to break back below, volume supports it, and sure enough, we then have another high volume move, breaking out, continuing the trend because it's harmony. Divergence, very simple and extremely common in crypto. This is one to really look out for. It's a high volume break, in this instance, below support. But look at the difference. High volume below support break, but immediately that support doesn't get respected. We straight back inside, and in fact, it stays as support, rather than flipping to resistance, which is what you would expect if the trend was going to continue. That's a divergence. The high volume couldn't move us lower, and therefore price reverses. That's where you can enter longs, or if you were short on this breakdown or short in this trend, you know probably you should get out of that short and cover before you get squeezed. So effort versus result is extremely, extremely important as a building block of not just Wyckoff theory, but understanding price action. These are the patterns you need to spot. The patterns are not just flags and pennants and wedges. Patterns are phases of price action, harmony and divergence. Is price agreeing with volume, or is it in disagreement? That's all you need to think about in terms of this. And in future lessons, we take that even further, looking at entire structures within the Wyckoff theory and in price action. But really internalize this, take notes, watch it, look at the charts, and start to analyze how does price react in each of these phases.